Welcome to Investing for Beginners podcast. Today we have a really special show. We have our friend Joe Saul-Sehy, who's joining us from Stacking Benjamins. And Joe is one of my original influences in the whole space. And I wouldn't call him the OG because that would be bad, but he is one of the legacy people in the finance space. And he's here to join us and talk all kinds of things money. So Joe, thank you for joining us today. We really appreciate it.
Dave and Andrew, thank you so much for having me. I've known you guys for quite a long time, and I'm just here to announce my retirement. What's better than being on Investing for Beginners? Like that's the top of the mountain. So I'm done. Life is good. And yeah, nothing else to see here.
All right.
Love it. Are you in your mom's basement today?
Of course I'm in my mom's basement.
Good.
You have to record from mom's basement because rent's cheap there, right? Mm-hmm. I mean, that's the deal. If we're being frugal, if we're being good with our money, we want the cheapest rent we can get. So mom just makes us clean up a little bit and life is good.
There you go. How are things in the backyard? How are things? Do you like my little transition there?
Yes, things are really good. Things aren't good for most people. If we want to get, take your joke, Andrew, make it a little serious. Like obviously with the tariff stuff now, like we're not sure what's going to happen there. I know a lot of people are really worried about their investments right now because of that. And it's funny because I just did a thing for I used to be for 9 years, I was on television in Detroit. And if you guys don't mind, I'll share with you what I shared with them, which is that I think the place to be worried is in your budget. And if you're not tracking your expenses right now, that's a huge mistake because the same stuff you bought last year, this think tank at Yale I just read yesterday said that they believe that for the average American family, it's going to cost $4,200 more to buy the same stuff in 6 months that it cost 6 months ago to buy. So I think it's really important there. But then this TV guy then goes, but you know what? The stock market went down, right? The stock market's been just horrible lately. Like, are you worried about stocks? I'm like, well, if you believe the economy won't continue, then just throw out all your stocks and find a cave and a gun. And I think you're good. But if you think that like everything else, this too will pass and these brilliant people that run companies will find a way to continue to find a profit even around tariffs, and they will, Coca-Cola doesn't just automatically go, oh, we're screwed. The price of sugar is going up. No more profits for us. Let's just let's just stop making Coke. Like they're going to think about a way to creatively pass it on to the consumer, make the good cheaper. They're going to innovate. They're going to do all these things. If they find a way to make a profit, then this is a buying opportunity for your portfolio. So everybody's worried about their stocks. I'm worried about your budget. Don't worry about your stocks, worry about your budget. I think that's, so yes, in my backyard, grass is going to cost a little more, Andrew. I did mean that to be as I didn't mean grass. I meant Everett Scott's yard grass is going to cost more. But I'm getting myself in trouble here. But your investments, let's keep on keeping on.
Love it. Yeah. You mentioned expenses. How did you learn about expenses budgeting? Do you remember when you saw the light on that, or did you come out of the womb just with a Excel spreadsheet in hand?
Oh, I did things the dumbest way possible. Like I was a money nightmare. So here's my story, Andrew. I was at the Citadel, at the time it was all men. It was Men's Military College of South Carolina. Citadel's a great place, Charleston, wonderful place. But the key here is I couldn't have a job, right? There was no job that I could have. And yet I walked into my first week at the Citadel and I saw this line. I don't remember if it was for a Frisbee or a beach towel or whatever, but I get in this line and it's for an American Express card. And so I get the American Express card and immediately the first time we have leave, as it was called, on a Saturday, we go to North Charleston where there's this mall and I go with my friends to this high-end restaurant that you guys may have heard of. It's called Ruby Tuesdays. I don't know if you're familiar with it. Salad bar and everything, like super high-end. But we get to the end and, I'm just trying to make friends. I have no idea how credit works. I have no idea how a budget works. I have no idea how anything money-wise works. And I just knew that this would be pretty powerful if I paid for everybody's lunch. So the bill comes and I go, guys, I got it. Grab the bill, because I'd seen my dad do that before, grab the bill. I got it. And I slap down this brand new American Express green card and I buy that. Then I march down to the other end of the mall. I'm in Charleston, South Carolina, where one time at 2:00 in the morning, they woke us all up because it was snowing. It literally snowed one day and everybody went crazy about the snow. And I saw this sweater, this Nautica sweater on a mannequin, like probably the most expensive sweater in the store. And of course, you guys know I bought that, right? Plus I have to wear a uniform all day. Where the hell am I going to wear a sweater? I can't wear a sweater in Charleston because it barely is cold enough. And then number two is I got to wear a uniform all day, but I buy the sweater. And I still have the sweater to remind myself of what it is. If I would have known, Andrew, we were going here, I would have worn it today so you could see it. Because this thing is like... Yeah. This is 1986, so it is Duran Duran ugly. Like it is so Duran Duran ugly. Like if I had hair, it'd be all spiky. So I remember like 3.5 weeks go by, and then we didn't have email, so I would walk to again the place where you got your mail. And if you think about like if you ever been in the post office and they have those old time postal spots where you can see through the glass whether you've mail or not, and you go every day and you'd look and see if you got mail. 90% of the time you didn't, but if you had a letter maybe from your girlfriend back home, like that was going to be awesome. I remember I go there one day and there's a letter and I'm excited. I open up, it's from American Express. I am not kidding when I tell you guys I had no idea what this letter was about. Like I had zero idea. I thought they'd be thanking me. Like we're a team. We sent you plastic. You used it. This was amazing.
Congrats.
I remember how 100% confounded I was when it was a bill. And this is American Express, the green card where you have to pay for it. The whole thing. Like right then. Mm-hmm. I have no job. I have no idea how I'm going to pay. Like it's the first time it's hit me that I'm going to have to pay for that lunch and that sweater. So I did what any responsible human being would do in that crisis. I called mom and I said that, have you guys ever read those books, The 1 Minute Manager? Mm-mm. The 1 Minute Manager series of books?
Yeah.
They're these, they're these older books. They're great books because it's just a story about being a good manager. But it was a whole series by Ken Blanchard, but one of them was called The 1 Minute Manager Meets the Monkey. And the way that this book works is that, and Dave, maybe you've seen this before. I walk into your office, I work for you, Dave, and there's a monkey on my back. The monkey is the problem, right? Mm-hmm. There's a monkey on my back. I walk into your office, you're my boss, and I go, Dave, we've got a problem. And the second that I say, we've got a problem, the monkey has swung one arm around your back.
Right.
And then what does the average bad manager do? They go, oh, I got this. I'll take care of it. It's mine. And I walk out, brush my hands because there's no monkey on my back anymore. It's your problem.
Yep.
Well, I hadn't read this book yet, but this is totally a 1 Minute Manager Meets the Monkey thing. I call up my mom and I go, Mom, we've got a problem. I'm hoping like Houston, this is going to be horrible. And I'm hoping Mom's going to say, I've got it, right? And she takes the monkey and takes care of it and I'm off the hook. Well, Mom didn't do that. Oop. Mom said, no, you've got a problem, which by the way, in 1 Minute Manager Meets the Monkey, I learned many years later is exactly what a good manager should say. You've got a problem. I will help you handle it, but it's your problem, not mine. And my mom said that. And so 2 months later, the card was gone, right? My credit was ruined. And I spent, and I don't know, it wasn't an egregious amount of money. At the time, it could have been $1 million, didn't matter how much money it was. But I spent the entire summer then working to pay off the collection agency. It was funny a number of years later, by the way, when I became a PR spokesperson for American Express, the financial advisor division, and they're doing their stuff. I'm like, you guys ever hear of a background check? Like, how am I going to go do TV and radio for you guys when you wouldn't even trust me with your credit card back in the day? So no, I do remember, Andrew, to make a short story really long and to end it right here is that I finally got to the point where I was so busy digging a hole. I finally realized, I looked up and I saw how deep the hole was and I realized things need to change. And at this time, by the way, I was out of college. I was away from my first jobs. I've been a financial planner for other people, and I'm sharing these tips that work for other people, but I didn't think they applied to me. I was living this lie that is the same lie I see people still live today, which is if I just make more money, I don't need to budget. I just need to make more cash. Well, it didn't matter how much money I made. Like at the time, my first year as a financial planner, I made $85,000, and this is back in 1993. So every 18 years, prices double. So for people for equivalent, that's like making almost $200,000 right now, right? My first year, I'm making like $200,000. It didn't matter. If I made $250,000, I would have spent $280,000. If I made $280,000, I would have spent $320,000. I needed to learn that my income needed to be divorced. Divorce, I think, is a great word, from my expenses. And I need to lock down those expenses. And I needed to surround myself with better people that would help me do that. So when I saw the light, I was getting calls from all kinds of creditors that wanted a piece of me. And that was horrible. But when I took charge, it was amazing how, when I changed my mindset, how quickly I got out of, at that point, a ton of debt, just tons of debt. I had $85,000 of IRS debt on top of probably $45,000 in credit card debt.
Ugh.
Yeah. Yeah.
That's a fun place to be.
Yeah. Nah. You know what was funny though, Dave? I'm going to say about 6 weeks later, it became fun. Because when I realized that I was in charge and nobody but me was in charge, and I could create the change myself to get myself out of that hole, I will tell you, digging myself out then became fun, because then you kind of gamify it. You know what I mean? And when creditors called me, I started picking up the phone. I mean, it was fun to actually answer the phone. Like that's a friend of mine's a comedian, Paul Ollinger. He's like, you know what's fun to do when you pay your bills on time? Answer the phone. Like it's wild. So, but I would answer the phone and they go, hey, you have to do this. You have to do that. And I would just tell them, I go, no, I don't have to do anything. I don't have to do it. I can literally burn it to the ground and there's nothing you can do about it. So we're playing by my terms. And you know what? You're waiting in line. And the cool thing is I never declared bankruptcy. I paid off all the debt. I paid off everybody. What was wild, by the way, and this is a story for another day, but credit agencies kept coming after me after I paid the debt off. Like this is such a slimy industry that I sometimes had to pay. I had to prove on this one debt, I had to prove 3 different times that I'd already paid it because of the slime balls out there that are just trading this bad debt over and over and over. So I feel bad for people that are where I was, because I get how hard it is to get out of that hole.
Yeah, it really is. So much there. I think one of the misconceptions, and you mentioned this a little bit, you can make so much and then spend even more. I think people think, oh, I just need to find the next Tesla, the next Nvidia, and it doesn't matter where my expenses are. You know, I just find the right stock and that takes care of anything. I haven't really heard many stories where that's actually the case.
Isn't it funny? I was talking to a guy recently, not on the podcast, but like a conversation, like, I don't know, when you guys and I have met in the hallways at podcasting conferences, we always have these great conversations, you know, and I had this conversation with this guy and he said, I think our view of risk is too small. And I'm like, what are you talking about? He's like, why does every person you meet want your portfolio to take all the risk? Like, why do I want my portfolio to create the Tesla, to create the Nvidia, to create, you know, the last 10 years of Microsoft, you know, before all the wheels came off the bus on all those? Like, why am I expecting that out of my portfolio? And yet I look at my career. I haven't asked my boss for a raise. I haven't looked to move companies and use my skill. I haven't taken any coursework to make myself more valuable. Like career risk, really, if you start taking some career risk, the way we think about our portfolio risk, we're going to stop bitching about how I haven't found the next Tesla, and I'll start getting busy finding ways to make more money so I can just go buy an index fund and you know, I'm making millions of dollars, and it's okay. If you're making millions of dollars, it's okay to just have the boring index fund, right? You're not relying on the Tesla. And I love that. I should ask that dude to be on the show immediately. Like, come on, let's talk about that.
Right.
Yeah, that would be entertaining probably to talk about them. Why do you think so? Why do you think people do focus so much more on the portfolio and not on the other aspect of life, i.e., budgeting, i.e., trying to make yourself more marketable so you can make more money? Why does everybody focus on, is it because the stock market is air quote easier?
I don't know, but you guys know from having this show for so long and us having our show that when we talk about something that might in the title imply get rich quick, even though we're not trying to do that, like my downloads go up, which is crazy because you guys know, and I love the way you preach this. And of course we preach that there's no such thing as a free lunch. I mean, it's funny. They call these old people in the 1800s, the robber barons, and I'm not going to paint these people as saints, but Andrew Carnegie built something. John Rockefeller built something. Jay Gould and JP Morgan, they built stuff. Like, don't get me wrong. They did some bad stuff, but they built something, and it was never a free lunch. It was building that stuff was never a free lunch. Look at all these cities that were built based on the stuff that they did. And I think we need to adopt that way of thinking. But I think our brain, maybe Dave, you and I have had it both, I think, described this way. Our lizard brain is just naturally lazy. Like, how can I do the least work possible? And it's why so many people play the lottery. And I think when we first get into investing, we think of the stock market as just another lottery where it maybe is rigged a little bit more in my favor. If I can dig in and find something in the financial statements or predict what this company's going to do next, well, then I'm going to hit this home run. And by the way, if I apply 5x leverage, now I can really win, and then I don't have to work. Which, by the way, when we think about this concept of not work, what's funny is that I have been doing a lot of digging on the science behind what the happiest retirees know. And you know what? You know who the unhappiest retirees are? The ones who don't work at all in retirement. The people that consider it to be a vacation, they die sooner. They have less fun. They end up with all these chronic diseases earlier than they would. People that actually get out of bed in the morning and they're happy in their retirement because they're getting out of bed to do a pursuit that they're much more likely to work when they were working the original 9 to 5, but they treated retirement just like another 9 to 5, but they loved it. Those people live a long time and they report this incredible amount of happiness. The average happy retiree, they volunteer for at least 3 different organizations, and they officially belong to one. And this will be like a Rotary Club or a Kiwanis group, or, maybe it's even the local garden club, but they treat it almost like it's a job. But now they're doing this thing that gives them this sense of, even if you're an introvert like I am, and I know a lot of people listening are like, you're an introvert? I play a really good extrovert, but I need 3 days after this interview to be by myself.
Only 3?
only 3. Yeah, I'm not an extreme introvert, but I do need rest up. And even introverts need this. There's a cool documentary, in fact, called Join or Die, from this gentleman who's done just a ton of research and talking about if we don't join organizations during, wherever we live, whatever we do, we tend to die sooner. So even this thing that we're all chasing, right? This easier lifestyle, beware what you wish for, because it might not be the unicorns that you think it is.
Yeah, that's very good. And, honestly, I see that with my mom. My mom is 86 and she's obviously retired, but she's been complaining to my sisters and I about not having a purpose. She's bored. She doesn't have anything to do. She doesn't have anything to look forward to. And, she can do anything, but so now we're trying to give her a purpose. So to your point, I see that in my own life directly.
How cool is that though? You're 86 and you're thinking about purpose.
Right.
Like I just think if you're having any inner dialogue, like, how do I make myself useful at 86? It's just a kick-ass thing to be thinking.
Oh, yeah,
I'm hoping I'm
sure.
thinking that. One of the studies that I've read, well, and I'll give you 2 of them, but one, Dave, to your point, was researchers did a study at a nursing home. They took half the people at the nursing home and they gave them a plant and they said, don't let this plant die. Don't let it die. And you already know what happens. That half of the nursing home lived longer than the control group, which was just left to do whatever they were going to do anyway. As a group, they lived longer. We had a woman on our show a long time ago. Anna Corwin was a researcher at UCLA. She did some research around Catholic nuns. Catholic nuns don't retire, and they live almost a full decade longer than the average person lives. And the reason is, to your point, Dave, purpose. A Catholic nun is going to have a purpose until she dies. She's got this reason to keep moving every day, to get out of bed. It's pretty cool.
So you're saying if I want to live longer, go have kids? Because I thought that was the other way around.
You thought now that you've had kids, like it's just, yeah, it's dying. The bad news is, well, you will see, Andrew, that you'll continue to have less hair. I have twins that are almost 30, and look at what happened. I used to have a nice full head of hair, and that's all gone. So kiss your hair goodbye.
I'm still struggling to picture you at the Citadel. I mean, just I'm still having a hard time, visualizing that.
Those were good years. And what's funny about those years is, and I think this is a good lesson. Like, as I said earlier, I've messed up a lot of stuff, but this, Dave, is something I think I got right, which is when I was applying to different colleges, I thought I had a track and cross country scholarship to the University of Nevada. So the Wolfpack, go Wolfpack. Well, I went out there and visited. They said it was coming. National signing day came, where you sign on the dotted line, and my letter of intent didn't come. And it didn't come and it didn't come. And finally, 3 days after we thought the letter was coming, she calls the university, and I guess the university was going to ghost me because they had gotten a new athletic director. And instead of having these track and cross country scholarships, they were moving more money into football and basketball and the revenue sports. And by the way, you've seen the Wolfpack do very well in football since then. That's on my back, guys. That's because of me. That was my scholarship. So go Wolfpack with the money.
Why aren't they
that was
naming the
promised to
stadium after you?
they should. So now, by the way, so it's mid-April, and here I am, a college or a high school senior, and I've done nothing. I've literally applied nowhere because I had bet everything that I was going to University of Nevada. And so my mom worked at a Catholic church, and she this is even, some of these stories just show how old I am. Like she had the mimeograph. Remember, Andrew doesn't remember the mimeograph machine. Dave, you might, but the mimeograph was before the days of photocopiers. Mm-hmm. So I write up this 2-page letter. The first page explains my situation because I wanted to go to Michigan, Michigan State, Notre Dame, schools in my backyard. Admissions are closed. I can't get in. Mm-hmm. So now I have to go to some place based on my running. And so she writes up this 2-page letter. First page explains my situation. Second page is all my times. My mom made me, like she did in college a year later, she made me pay for all the postage. I went to my guidance counselor. He, on this big old huge floppy disk, puts it in the Peterson's Guide to College floppy disk, puts in all the schools that give scholarships for track and cross country. And he spits it out, and then I have to take it and then look at it to make sure it's not an all-girls school, right? Number one. Number two, that it's a school that isn't like a D3 where they can't offer you money. Mm. I needed money to run, so my teacher let me take my homeroom and turn it into an assembly line for a series of days. And my buddy Patrick says, send this letter out to the Citadel, the Military College of South Carolina. And I'm like, no, we're not sending it. No. Because to your point, Dave, like, look at me. No. Yeah, probably not doing that. And the guy, my buddy goes, no, send it as a joke. So it's cool. And this is a lesson. Like, you put stuff out to the universe, right? All of a sudden, my phone starts ringing off the hook. Every day, I've got a ton of mail, and my phone is ringing with call after call, coach after coach after coach calling me because I reached out to them. I wasn't waiting for other things to happen. I reached out to them. This is still true. 57 years old is true. When I reach out, things happen. If I don't reach out, nothing happens. It's magic. So it's like the fourth call of the night, And I'm talking to this coach, and it sounds awesome. He's talking about palmetto trees and warm weather. Like, I saw this cool stuff, and I'm like, I'm sorry, coach, I missed the name of the school. He goes, yeah, it's the Citadel, the Men's Military College of South Carolina. And I start laughing. In this coach's face, I start laughing. I'm like, yeah, that was a joke. My friend Patrick, I'm not going to a military college. And he goes, well, let me send you the stuff. Just let me send it to you. And so he sends me this, my mom hands me the mail, and I go down to my bedroom, which was in the basement, of course, true to form. And I go in this, it's like a bomb went off in my bedroom. Just, your average teenage bedroom, just crap thrown everywhere. And I open up this thing, and it's this picture of this Confederate looking uniform, right? Charleston, South Carolina, this beautiful helmet called a Shako. And it says the Citadel, where manhood meets mastery. And the whole thing is about getting your stuff together, getting your life together. And I look around at this room, and I remember thinking, and it was a rare, great thought, which is, you know what? I think I need this. Like, I seriously think this would be good for me. And I got to tell you, it was good for me. It was great. I learned so much about life, and so much about, these people. Once I realized that the people couldn't hurt me that were hazing me, like, life got so much better. I was like, no, bring it on. Bring the push-ups on. Bring the stuff on. Haze me more. Let's go. Let's go. Make me tougher, please, God. And it helps with stock market downturns. I mean, to take it back to investing,
Nice
if
segue.
my stock Dave, if my stock portfolio goes bye-bye, I'm going to be okay. If I lose now, I don't want to lose everything, and I want to mitigate risk. I want to think about risk, and I want to control my risk by being diversified and by buying smart things. But if my portfolio goes down, I'm not going to die. I'm going to be okay. And if all my money goes bye-bye, I have what it takes inside me to continue bringing home money. Do I want that to happen? No, probably not what I want to have happen. But yeah, a lot of lessons by, that frankly today can read. I'd recommend people read the Stoics to get a similar experience, right? Go read Marcus Aurelius. And I think you'll get a lot of what I got out of the Citadel.
Yeah. Yeah. Guys like Seneca and stuff. Yep.
Yeah.
That's super cool. Do you feel like, I don't want to say like rules of the game, but you mentioned a few things like taking career risk and balancing between, the different options you might have at different phases of your life. Do you feel like, maybe if you're at a certain number, it's better to focus more energy on something on the career risk side? And then if that's a sliding scale, if you have a certain number, you should be investing in a different way. Like, do you have any thoughts on that kind of sliding scale when it comes to finances?
You know what I love about what you and I do is we get to talk to all these smart people all the time. And what you find, Andrew, is that so many people have sliced this so many different ways and they still won, which is great. It doesn't have to be one size fits all. I will say this though. I really like what Jonathan Clements told me on Stacking Benjamins. He is for people that don't know who he is, he's Humble Dollar. It was the former personal finance columnist for the Wall Street Journal, and a guy that a lot of people have a lot of respect for. He just went public last year with the fact that he is dying, and he's written a lot about the process of very thoughtful stuff. And it's amazing these gifts he's giving to the world about that. But Jonathan told me a few years ago, when you're just out of high school or just out of college, you don't know. I mean, unless you're the top 1% of 1% of families, you don't know super bougie stuff yet. You don't know any of that stuff yet. You love camping. You love sleeping on the ground. You love, I used to love eating Hamburger Helper. Like, that was great. And then it was funny. I was engaged to my wife and I would still eat Hamburger Helper. And then I'd roll around on the floor because my stomach hurt like hell because of all the crap that's in Hamburger Helper. She's like, why do you do this? I'm like, because it tastes so good. It tastes so good. Like all of this, ramen, like, that living a cheap lifestyle is easy when you're young. And if you learn to appreciate and love all the frugal stuff, like that is a huge lesson, loving frugal when you're young. And then the second thing is learning hustle. It's easier to hustle right out of the gate than it is to try to pick up hustle when you're 40. If you're trying to learn how to hustle when you're 40, when you haven't hustled when you're 20, you haven't hustled when you're 30, you're going to get exhausted very quickly. You're going to think that 15 miles an hour is 150 miles an hour. Like, you get used to the pace, right? When I was a track and cross country runner, we would do these tempo runs to get used to the pace. You would get used, this is the pace I want to run. We would run a tempo run. Then we would do speed runs so that we could turn over our legs quicker to try to increase that tempo run. So we would get used to being comfortable at a faster pace. If you try to do that at 40, it's going to take you a hell of a long time, especially, Andrew, talking about kids. If you've got kids, you've got a house payment, you got all this stuff, you got a boss yelling at you, barking at you, all this stuff. Creating this new you at 40 is going to be much harder than if you'd done it at 20. So the cool thing is, I've seen people succeed by going for a rich lifestyle at 20, by spending a lot of money at 20, by doing whatever the hell they wanted to and YOLOing life, and they still made it. But I think I agree with Jonathan that it's a hell of a lot easier if you get a little bit stoic, you figure out how to hustle, you love the cheap lifestyle, you differentiate your expenses from your income, you shovel money away as fast as you can. Like, I just think that's an easier path to greatness. The only bad thing is that I feel like a lot of people that are in their 20s, they think of it as sacrifice and they don't enjoy it. I think if you don't enjoy it, you got to get the hell out. Like, if I had any life experience, the things that I hated in life, I should have eliminated quicker. I should have gotten rid of them quicker, because I think enjoying the hustle and enjoying the frugality, enjoying those little moments and learning that that's fun, I think leads you to a higher truth, which is when you get to retirement, spending more money does not equal more fun. It doesn't. It can, but it doesn't. And I think a lot of people think, oh, I'm not going to spend money now and I'm going to spend it later, and then it's going to be incredibly joyous. Yeah, no. Because you know why? Because you still show up. And if you're miserable earlier on.
Right. You just have more money miserable.
That's right. You're showing up to your problems in a limo, which can be kick-ass. but you're still the same miserable you. So yeah, I think, Andrew, I don't know if that answers your question, but I think that's probably the path I would tell people to take.
Yeah. I'm stuck on when you said limo. I don't know the last time I've seen one of those.
Maybe it was my wedding or one of my friends' weddings that I was in a limo. Like, that was it. You know what does change though? I mean, let's talk about investing. Let's throw some gasoline on this fire. How about this? So I think if you're in your 20s and you're thinking a lot about the individual stocks that you're buying, you're thinking a lot about your asset allocation, I think you're an idiot. And by the way, you're not an idiot because you are a moron, because you're smart. If you're listening to the show, you're incredibly smart. People in their 20s don't listen to stuff like this, and they should. And if you are, you already have a leg up. But the reason I think you're getting it wrong is because of the fact that risk doesn't matter that much when you don't have a lot of money. And I want to put that in context. I don't want to go buy penny stocks because that's just foolish. Unless you got inside information. Then if you can avoid an orange jumpsuit and do that, then that's great. Then go do it. But if you don't have any information, I think diversifying your portfolio in a responsible way, but then notching that risk lever up is great. So, if I was 22 again, I would have had a small cap value fund, and I would have been shoveling money into it as fast as I can, hoping for ups, high five myself, hoping for downs, high five myself because I can put more money in, right? But I'm not worried about, I spoke with Nick Majuli, the of Dollars and Data guy from Ritholtz, and Nick said he spent way too much time worried about very scientific diversification when he was in his 20s. He was very, very worried about that. He's like, I shouldn't have done it. You know what I should have worried about? get something where it's volatile so that I can take advantage of peaks and valleys, and then worry 100% of my career and shoveling as much money in as I possibly can. And he said, and I tend to agree, that when the motion of that ocean of now I've got a big enough pile of assets that the motion of those assets matters more than me putting money in. In other words, in a month, I put in $3,000. And during that same month, my portfolio goes up or down $4,000 based on just the market movements. That's when I need to start getting more scientific. At that point, I need to. So, begin with in my mind, the total stock market index that J.L. Collins famously wrote about. Love that guy. Love starting with VTSAX. But you get to maybe $80,000, $100,000. Now I think then we start getting more scientific and we start diving into our asset allocation.
Can you break down VT SAX for people who maybe are tuning in? They're new to the
sure.
show, new to
have never heard about this.
Mm-hmm.
I'm gonna give credit where credit's due. J.L. Collins took the biggest fear that new investors have, and he put his arm around you and said, you don't need to be afraid of that anymore. Because what's the thing every new investor worries about? What do I invest in? I'm hearing about crypto. Crypto's blowing it up. Do I invest in crypto? I hear about NVIDIA. After the whole DeepSeek thing, is NVIDIA coming back? Maybe I should invest because it's down. Tesla, right? Is Elon Musk going to get his reputation back? Like when is Tesla going to be the future like it was for a long time? Like, what do I invest in? And people freak out about that when they start out. And J.L. Collins, if you've never read the book, Simple Path to Wealth, you want to read this book because especially if you're starting out, he says, you know what? And he wrote this book originally for his daughter, to tell his daughter that book is an audience of one that it was meant for, which I think is some of the best books where you feel like you're in on this conversation that the author's having with a specific person. You're like a fly on the wall, listening. And he's telling his daughter, don't worry about any of that. Just buy a little bit of everything and you're going to be okay. And the cool thing is Vanguard famously and other companies have created products where they package up every investment you could possibly buy in the stock market and you buy a little bit of everything. And now you can freak out about what you should be freaking out about, which is how do I make more money? Or how do I shovel more in? Maybe not even make more money, right? How do I get a lifestyle where I can put money in here to the point that it moves the needle? And then he goes on to show how scientifically buying just a little bit of everything, you're going to be okay. If you never change that allocation, you will be okay. Now, I think you're dumb if you keep doing it over $100,000 because you can easily beat it. You can easily beat it later on. And I know a lot of people know that you can easily beat it. But man, just guys, as you know, not having that pressure of what to invest in when you're first starting out, like that's what I'm worried about. I'm like, am I in the right stuff? Am I in the, man, if I could just buy the total stock market index and then I can free up this headspace to do a lot of other stuff. So VTSAX is the mutual fund version of the Vanguard total stock market index where you're literally doing what he's talking about. A more efficient way to buy it, in my book Stacked, I talk about mutual funds and how they were created. And then, modern architecture came around. In the book, I call it mutual funds hotter cousin. Like everybody had that hot cousin, mutual funds hotter cousin is the exchange traded fund. And all it is more modern architecture where you don't have some of the tax consequences. You can buy it or sell it wherever you want. You want to put a stop loss. I wouldn't put a stop loss on it, but you can put a stop loss on it if you want. You can do you get so many more things with an exchange traded fund. That is VTI. So VTSAX is a mutual fund. VTI is the exchange traded fund version of the same thing.
That's awesome.
I recommended a stock a couple of years ago that's up pretty big. I want to share that with you so you can see the type of analysis that I do for paid subscribers. Download it for free at stockwriteup.com.
So how do you feel about, you mentioned something before we came on the air about target date funds. What are your thoughts on those?
Well, I don't like them. And I get flack from this because people are like, oh, that's the easy way to start. It's pressing the easy button. Let me tell you what this does. A target date fund is so easy that you don't know why the hell you own it. You don't know why you own it. You just know that you should. And so I can't be bothered to do anymore. So I'm just going to put money in here. So if I don't understand the basics, and you don't have to understand every single little thing, right? But if I don't understand the basics of how stocks work and how they react when a thing like tariffs happen or a pandemic happens, if I don't understand the wiring just a little bit, I'm going to blow up my strategy. And so I see these, you know, I said that it was stupid to worry about diversification when you're young, Dave. And I do want to back off that because I think a lot of people just don't know better. It's not being stupid. It's just, you just don't know better. But a target date fund is so lazy that you'll see these people that they will move their money out of a target date fund to a different fund because the fund's going down, which is ridiculous because a target date fund is a fund of funds where you're asking a management company based on a date. Let's take 2040 as an example. I want to retire at 2040, get me there safely. And so it will start off with an allocation here in 2025 that is, 15-year risk level allocation. They'll give you a bunch of funds based on that. They'll charge a fee for that. This is icing on the cake of why you don't want it. But inherently, the fees are not the reason why I don't like it. But as you get closer to that 2040, it backs the risk down, and you'll go from almost 100% stocks to almost 100% bonds, or 100% bonds when you get to 2040. Which brings up the second problem. Not only do I not know how it works, so I'm going to do dumb stuff and I'm going to sell it when I've already hired this management team that knows how to sell it. The second problem that I have is this management team isn't worried about you. You will never see in a Vanguard or a Fidelity or T. Rowe Price or an American Century piece of literature, we don't care about you, but they truly don't. It did make the cut for the marketing, but they don't. You know what they care about? They don't want you to sue them. And because they don't want you to sue them, what every report you will ever read, every scientific study a target date fund shows is they land the plane too early. They take less and less and less risk because they know that the people that buy this junk don't understand risk. And because of that, they're going to back the risk down, back it down, back it down, back it down, so they don't have a class action lawsuit on their hands later on, right? So the problem is most of us are able to, according to a lot of studies, just barely make it to that financial independence number, right? When we want to get there, like we have just enough money to get there. Too many people saving too little money. We need that last double. So there's this cool rule called the rule of 72, where if you take the interest rate you think you're going to get divided into 72, it tells you how many years it takes your money to double. So if you're going to get a 9% interest rate on your money, 9 divided into 72, every 8 years, your money's going to double. Well, so let's say that you're sitting on $500,000 and you're 8 years away from retirement. The target date fund is backing down the risk level, making it more unlikely that you're going to take that $500,000 and make it $1 million, which $1 million gives you a $40,000 lifestyle. $500,000 only gives you a $20,000 a year lifestyle using the 4% rule, right? Which, we can talk about that too, but it doubles your lifestyle. We need that. And you're not going to spend all this money the day you retire. I mean, if you do, I want to be there. Like I want to sign me up for that party. I mean, Dave, you were in a band, Dave. You know how awesome that can be.
It could be,
right?
Yes.
But some of this money is still 20 and 30-year money. Why the hell are we landing the plane with all the money? We don't need to do that. And so the fight that I have with people, with well-meaning experts, is like, just start with a target date fund. I'm like, let's cut that out right now. And instead, let's take an hour. Please, God, take an hour. If you take just an hour, you can understand just enough to set up your own little target date fund. And then you know what you have, and you're much less likely to blow yourself up when bad stuff happens. Your fund, you're going to be sticky. You're going to hang in there during the bad times. Also, you're going to do it partly for another reason, which is you set it up, right? So it's funny. I'm a big fan of board games. And there's this thing that when people kickstart board games, they tend to rate them higher on Board Game Geek, this place where geeks go and rate their board games. You know why you bought it, or you know why you rate it higher? Confirmation bias. I set this up so it rocks. It's the reason why we hold on to stocks for too long. We hold on to, no, Tesla's going to be fine. I swear to God. Come on, Elon, make it come back. Right? Right. And yet here's what's happening in the big world. This blows me away. As we record this, people on the inside have been selling Tesla shares, right? People on the inside have been selling Tesla shares. The fundamentals have been freaking horrible. And given it is mostly around the haters out there, you've got the CEO of the company, Elon Musk, who's got a president who's been saying forever and ever that electric cars suck. Suddenly he's selling them on the Wall Street lawn to help out Elon. That's how bad it is for this company. And yet, ma and pa investors, the type of people that listen to your show and my show, these people are buying Tesla stock in record numbers. And you're like, everything about this stock from a fundamental basis sucks right now. Like it sucks right now. And ma and pa are just buying the storyline. Like it is crazy what we do, but you're going to hang in there more longer. But my big point is that you're going to hang in there longer if you don't buy a target date fund, you set it up yourself. I wouldn't base it all on target stock. I'd buy, heck, you could do it with 3 or 4 different funds when you're getting scientific about it. And you're going to be so much better off than you were with a target date fund for so many reasons. So yeah, that's why I don't like it. I think we're smart enough to learn it, Dave. I should have just said that first. Dave, I think we're smart enough to learn it. Next question.
You have so much more faith in humanity than I do.
Well, especially though, if you're a fan of investing for beginners, if you found this show, you clearly are smart enough to set it up yourself. Please don't listen to the show and go buy a target date fund. Listen to the show and set up a really easy portfolio. And by the way, by easy, I mean, you can manage it 15 minutes a year and you can beat the target date fund. It's not hard to beat the target. It's hard to beat the stock market. It's not hard to beat a target date fund.
Very true. Any other like scientific pieces of advice around some of this that we've been talking about that springs to mind that you think should be shared?
Well, I just think that, so people heard me say, okay, you get to $100,000, let's get scientific, right? And people are like, okay, no, how do I get scientific? What do I do? I go to ChatGPT and go, hey, science thing. I think the place to begin, and this is just going to be the beginning of the discussion for everybody, is I would just look at what science is out there. And fund companies like Dimensional Funds is an example. You look at their board of directors, it's a bunch of Nobel laureates. These guys are using science. And so if I just start looking into what is the science that the people, the scientists on Wall Street are using, what are they using? And then what should I use? The place where you're going to begin, I believe, is with this thing called the efficient frontier. And the efficient frontier, I hate the name because the efficient frontier makes it sound like it's hard as hell, and it's not. It's actually super easy. The efficient frontier won a Nobel Prize. A guy named Dr. Harry Markowitz won the Nobel Prize. Markowitz showed that given any time frame that you put in front of an investment, some investments have a low rate of return over that time frame, and other investments have a very high return over that time frame historically. And then as he looked at that on the x-axis going north-south, on the y-axis going east-west, he had another factor, and that would be as returns go up, he saw risk went up as well, right? Higher returning stuff had more volatility. He showed that, by the way, for the Uber nerds out there as a standard deviation. So that ocean motion I'm talking about, I love standard deviation. When I'm looking at an investment, if I go to Morningstar.com and I look at what's the standard deviation on this fund, I can get a feel of what the flight path is going to be. When the pilot comes on and goes, we're going to have turbulence, I know what the turbulence is going to be when I look at standard deviation. So great metric to dive into. talking about the science, but he showed standard deviation going from left to right. So he's got this graph. And then let's say he puts cash on that graph. Cash will be in the lower left-hand corner, very low return, no risk. And then let's take collectibles, right? A collectible craze will be up and to the right. They could return, artwork can return a ton of money, but there's so many other risks. I mean, somebody destroys your painting is a risk. It gets, destroyed in a fire. Like all these risks, the risk is very, very, very high. And so Markowitz, and I kind of like this because like you guys, I'm kind of a fanboy of all this stuff. So I like fan fiction here. So I think Markowitz puts this dot down, and he puts a dot down for large company stock. Then he puts a dot down for small company stock, and he starts seeing dots fill this. And then, because he thinks this is sexy like I do, I think it's like 10 o'clock at night. And he's like, what if I went like 50% of what's in that dot and 50% of what's in that dot, and I combine them like the Reese's, right? Peanut butter and chocolate together. Like, what if I go half stocks, half bonds? So I imagine him going over to the cabinet, grabbing a glass and opens up a bottle of Cabernet, puts on like some Barry White, because this is very sexy. And then he goes like, what if my dot was 20% real estate, 30% bonds, and 50% stock? Like, what would that be? What if it was like 70% small cap real estate and 30% gold? What would that be? But seriously, none of that happened, I'm sure, sadly, because I think it would have been more fun. But as you can imagine, he fills up this chart with dots. And what he showed was there is this imaginary line that kind of initially on the left goes straight up. And then as risk gets higher and higher, it kind of evens out. In fact, this is where everybody's heard of the law of diminishing returns. I can keep working. I'm just going to get no more. This is the same Nobel Prize winning stuff. Diminishing returns is efficient frontier. I can take more and more and more risk, and it's not going to matter that much. Where initially it matters a lot, right? So initially it goes up, and then it kind of just goes to the left. There's no dots north or left of this line, meaning everybody wants a dot that's up and left. There's no such thing, he proved. We want no risk, high returns. Doesn't exist. But let's take VTSAX as an example, or let's take a target date fund. That target date fund is going to be right in the middle of the mess of dots. There's going to be dots north of it, and there's going to be dots to the left of it. So what does that mean, Joe? It means that if I move that dot to the left, there'll be a dot to the left of it, which will represent some other portfolio where historically over my time frame, I have taken a lot less risk and I got the same exact return that I'm getting with VTSAX of that target date fund. And you're like, really? Yeah. Yes, it exists. The target date fund is going to be close to the efficient frontier because that's what the pros do. The problem with the target date fund isn't it being close to the efficient frontier. It's actually that it's not based on your goal. Your dot is somewhere on this chart that doesn't represent what you want. It isn't specific enough. But VTSAX certainly, because I've looked at this dot, you can go way left of VTSAX. You can take a lot less risk than that stock market, which is why I want it early on, because I like the risk. I like the volatility, because as I'm adding money, I want those down so I can put more money in. But when I get more scientific, what I also like is there's dots north of it, meaning if I'm sleeping good at night, I'm going to take no more risk, take the same amount of risk I'm taking now, but I get a much higher rate of return over that same time period. Who doesn't like that, right? Wow. More return, no more risk. Yes, it can exist. And Paul Merriman showed, this great guy, Paul Merriman, who's done a ton of, I went looking for the research. I was going to do the research, and I'd rather have somebody else do it. Cause like I said earlier, people are lazy and I'm a person. So I saw that Merriman did all this research, and he showed that given 52 years, and I don't know why I picked 52 years, if you invested $10,000 historically in 1970 and you ran it out to 2022 at the time, this is a couple years old, this research, he showed over that 52-year time frame, VTSAX got you like $1.85 million. A one-time $10,000 investment, which proves simple path. If you just buy VTSAX, you're going to invest way more than $10,000. VTSAX will get you there. You don't have to stress about the market at all. If you don't want to stress about anything, you don't worry about the efficient frontier, you don't care how much money you have, VTSAX, you will be fine. Simple path, you'll be wealthy. But Merriman proved that when you got closer to the efficient frontier, and I won't get way in the weeds about what he did, you ended up with about $4.6 million more over that same period.
Wow.
Meaning you take that 1.8, another $4.6 million, and it's just by spending 15 minutes a year, by having a portfolio that is a little more efficient, right? So if you start and you learn how the efficient frontier works, and there's places online, Portfolio Visualizer is a place to play around with it for free. By the way, portfoliovisualizer.com has a button on the lower left. It's a great website, and there's a lot of stuff that's worth paying for. But I'll tell you this, if you want to go there and play around with the efficient frontier, there's a big button that says start here. Do not click that button, because that button is everything you have to pay for. And the cool thing is Portfolio Visualizer makes it free for the efficient frontier. If you go up to the top, there's a little tiny button that says tools. Click that button, and in the drop down, it says efficient frontier, and you can kind of play around for free to start off with and get yourself acclimated. It's a little clunky, but over time, over, a couple hours, you can figure it out. And once you do figure it out, then heck, set up your portfolio on the efficient frontier, buy a few funds, rebalance once a year, and you're going to do much, much, much better.
Yeah, that is really cool. I'm going to check out Merriman's work, and I might have Friday night plans. We'll see.
Dude, you see, because you think it's as sexy as I do.
Yeah. Oh yeah.
You're gonna put on some Barry White. You're gonna get some Cabernet.
Yep.
And you're gonna bust out Paul Merriman. Yeah.
Well, this was so awesome, Joe. You are all over the place online. It's the amount of value you provided, through your podcast and then your book and just all the speaking you do is truly extraordinary. So people for sure should go check you out. Anything cool you've been doing lately? Where should people go to see what you're doing?
A fun way to get it. Thank you, by the way. And likewise, you guys too, spreading the good word. And I'm so happy you asked me to come on. This is, as you can tell, I can pontificate. I may have an opinion, but I think a great place to start, if you go back to our episodes that began 2025, we have a pair of episodes that really, I think, set up a lot of goodness that I think your listeners will like. And I flew out we broke our format a little bit. Our show has a lot of comedy in it. These two shows do not have as much comedy. We talked to a guy named Alex Hormozi. I flew to Las Vegas, where he's at. He's known for being an angel investor now, but he's a guy that learned how to make a lot of money. And so if you're younger and your goal is to shovel more money into investing and then go listen to Investing for Beginners, right? Alex Hormozi, he had such a dense interview with me, guys, that what I did was I recorded the whole thing. I brought it back to Mom's basement. I actually played it for OG and I, and we take what Hormozi says, we hit pause, and we dissect it for the average person. Because Hormozi talks to a lot of entrepreneurs. A lot of our fans aren't entrepreneurs. A lot of your fans aren't entrepreneurs. They're 9-to-5ers. But so much about what he talks about makes so much sense. He's like, so many people, here's a little one. A lot of people spend a lot of time not thinking about, they think about how to do as little as possible. He goes, my goal was to be as useful as possible. I want every single time anybody has an opportunity, they come to me. And so I was doing all this stuff for as many people as I possibly could, because I wanted people to know that if they wanted something done, to go to Alex with it. Now Alex is making tens of millions of dollars a year because he's made himself so useful. The second thing that he said, which I thought was really important, was to skill stack. If you're somebody who's in high school, don't get a job working down at the mall. Nothing wrong with what you can learn there. But if you think you might be interested in bookkeeping, see if you can work with a bookkeeping organization or do the very simple books for one of your parents' friends who has a small business on the side, like offer to do their books. And then you get a degree as a CPA. You already know small business right? Next thing you know, then you've got teaching credentials. You can then go teach it. You can take your teaching credentials. Now you know how to talk to people. You can use that to either become a CFO or mergers and acquisitions. You then become somebody. You take this little thing you did in high school and you stack skill upon skill upon skill. So he has, it was so big, we took 2 episodes. So our first 2 episodes of January, just go back to those, Alex Harmozy part 1 and part 2. And I think that'll help people get a lot of money to invest.
Yeah, it was awesome. A cool episode. I liked your studio. It looked really nice, by the way.
Yeah.
That was his studio.
Okay.
Yeah. Sadly, mine is right here. Mom's basement. This is what you get.
Yours looks
Nintendo's
good too, Joe.
over there.
Yours looks good too, Joe.
Thank you. Nintendo's over there with the board games. Yeah.
Awesome. Well, Joe, this was fantastic. It was a lot of fun to talk about, and probably one of the easiest podcasts we've ever recorded. So thank you for that. We appreciate it. For those who have not heard of Joe, please go check out his show. We'll put everything in the show notes so they can go and check out those episodes as well as everything else that Joe has going on. And with that, we'll go ahead and sign us off. You guys go out there and invest with the margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.